Yemen, although it is just a tiny oil producer, has quickly reintroduced risk to global energy markets. The country, located on the Bab al-Mandeb Strait, is the fourth biggest shipping choke point in the world by volume. The bigger worry, of course, Yemen sits on the southern border of Saudi Arabia, OPEC's largest producer. Strategists say an unsettled Yemen could also increase piracy from the Red Sea down to the Gulf of Aden and other regional shipping lanes.
The perception that there is conflict, there is war, air strikes, missiles, and so on, rocket attacks in Saudi Arabia, and that, of course, affects the price of oil psychologically.
With U.S. reserves at a record 450 million barrels, the global oil market remains awash with crude, and that's been the focus. Investors have been discounting risks for the last 6 months, but there's plenty to worry about in this volatile region. Libya remains an energy wildcard and sits on the largest proven reserves in Africa. And ISIS is a threat to Iraq and its plans to expand production and eventually challenge Saudi Arabia.
The major region for production of oil is very unstable, and we do need Saudi Arabia to be stable. And you saw that with the reaction from President Obama, who is supporting the action of the GCC alliance against what's happening in Yemen.
There is also the impact Yemen may have within OPEC, which is dominated by Middle East producers. Back in November, the 12-nation group proceeded with a Saudi-led plan not to cut production. Iran was against that move. With tensions on the rise, Middle East stock market investors are selling off in the face of conflict, with Dubai and Saudi Arabia seeing sharp falls in the last 2 days of trading.